is value the same as price?
No, actually, this is really interesting, and this comes from economics, not so much accounting. But in any transaction, there are three components. There's the value to the customer, there's the price the customer pays to the seller, and then, of course, there is the cost to the seller of producing the good or service. And so if you think about walking into a Starbucks and paying $5 for a latte, now, as an economist, take off our accounting hat for a minute and put on the economist hat. What's going on in that transaction is kind of interesting because I'm spending $5 for a latte that I could have made at home probably for 20 cents. And I don't think Starbucks is 25 times more valuable than the coffee I make at home. So that has a lot to do with context and the subjectivity of value. Values in the heart and mind of the customer. It's what they perceive the value. And the price they pay has to be less than the value. That way the customer profits. Now, economists call that consumer surplus, which is a terrible term, but I just call it customer profit. So as an economist, when I watch somebody pay $5 for a cup of coffee, I know for a fact it's worth more than $5. Now, Mark, we're accountants. We get hung up on, well, is it $5 and a penny? Is it 5 1/4? Is it 6.50? Well, hey, it could be $20 if you were hung over and have to go to some boring meeting or CPE course or something. And then you're going to be willing to pay a lot for that cup of caffeine. But the point is, I don't get hung up on the numbers. I just know it was worth more to you than you paid for it. So the customer has to profit and the seller has to profit. And we recognize this because when the barista hands you the coffee and you hand your money, you both say thank you. If only one of you was profiting, then somebody would say you're welcome, right? But you're both profiting, which illustrates a really important point. And this is really heretical to say on an accounting podcast, but in the real world, debits don't equal credits because that customer profit's not booked anywhere, right? We know how Starbucks is going to book the transaction. And if you kept fastidious books on your home accounting system, we know how you'd book the transaction. GAAP was designed to record transactions at an agreed upon price, not value, price, after the fact. Hence, goodwill. The biggest plug number in the accountant's world, goodwill is just the word we use to describe our ignorance. Because GAAP has nothing to say about value, because value is completely subjective.
We've started strong there, Ron, questioning debits and credits and goodwill accounting. So we'll keep things moving. But I think is it the Warren Buffett quote, which is that pricing is what you pay and value is what you get.
Correct.
Is a really good
Great line.
way of thinking about that one. What about a few other terms that we hear thrown around when it comes to accountancy, pricing, etc.? We've got time-based, fixed fee, value pricing, subscription. I'm sure we're going to use a number of these terms in the conversation today, but just to set us up on a level playing field, how do you think of some of those terms, Ron, to get us all on the same page?
Great question. I think of it in terms of pricing the inputs, the outputs, or the outcomes. So if you're doing hourly billing, you're pricing the inputs, your effort, your estimated costs, and your number of hours. Now, of course, those estimated costs have a profit component built in, from cost plus pricing. But essentially, we're pricing the inputs, right? And when we move to fixed pricing, we're pricing the outputs. We're saying we're going to give you this defined scope of work, and here's the price for this defined scope of work. If something happens outside of this scope of work, we'll have a change request, change order process, and there'll probably be an additional price, just like your auto mechanic does when he finds another problem, or your contractor as he's adding on your pool room and you bust through a wall and sees there's dry rot or termites, right? There's going to be a change order. And then we have outcomes where we're pricing for a particular outcome that we're going to guide the customer to. And of course, that's where value pricing comes in, because everybody's got a different perception of what that outcome is worth. So if you have a landscaper who's pricing you by the hour as they come out and mow your lawn and edge and do your bushes, that's pricing inputs by the hour. If they come out and say, okay, we're going to mow, edge, take care of the bushes, whatever, that's outputs. They're giving you a defined scope of work. But if you had a landscaper say to you, I will give you the best curbside appeal because I know you're going to sell your house in a couple years. So we're going to slowly, and on the landscaper's timetable and capacity uh, requirements, we're going to come in and we're going to upgrade your yard. And when you put it on the market, you're going to have the best curbside appeal. That's an outcome. And I'm willing to pay much higher for an outcome than I am for an output. So that's kind of how I think about it.
I love that. Inputs, outputs. A great way of, or the outcomes. Sorry, what was the third?
Inputs, outputs, and outcomes. Inputs would be hourly billing. Outputs would be fixed price. And Mark, I started in 1984, and I was doing audits, and we had fixed prices on them. It was very standard. Now, if there were things that came up, we would charge that by the hour and in arrears. And that's why there's no such thing as the term value billing, because billing takes place always in arrears, whereas pricing is always done up front. The customer always knows the price before they buy something. And that's true with all of our consumers. We know the price of things we buy because we want to make that value price comparison ourselves before we buy, not after.
I love a simple summary, though, of the inputs, outputs, outcomes. It's a great way of thinking about some of the shift here as well in terms of how we're thinking about pricing. How important do you feel pricing should be for accounting firms?
Oh, I think it's critical. First off, it's the number one driver of profit. So there's nothing a firm can do that would have a bigger impact on the bottom line than to think more strategically about their pricing. It drives profit bigger than, say, rainmaking or efficiency gains. Even with all the AI and offshoring and all of that, pricing dwarfs all of those in terms of its marginal changes that affect the bottom line. A 1% change in price has got a 3 to 4 or 5 times impact on compared to all those other things, efficiency, rainmaking, all of that. So most firms are not strategic about it. But to be fair to the professions, either was the corporate world. The corporate world doesn't pay much attention to pricing. Boards don't spend any time on it. And now, because of the rise of the professional pricing people, there's an outfit called Professional Pricing Society, and I am on the faculty, but I'm on the faculty because I had no idea who these people were. I found them around the 90s sometime, but they started in the mid 80s. They are almost single-handedly responsible for moving pricing into the C-suite. So now a good chunk, I'd say 40% maybe, of large companies like FedEx, UPS have professional pricing departments, and they're using pretty sophisticated software to guide them, with dynamic pricing or whatever it might be. And so pricing is really diffused in the corporate world. And luckily, it's starting to diffuse in the professional world as well. So I think that's a great, I'm very optimistic about the progress of pricing, even within the top 10 firms. You'd be surprised. They're doing some very innovative things with pricing, building their own proprietary software around it and offering options and things like that. So I'm thrilled with the progress.
In your books on value pricing, you really pushed the profession forward in leaps and bounds in many different ways, Ron. And I know you've worked very hands-on with a number of firms as well during that time to bring these concepts, these strategies, and implement them in firms. What are some of the things that you've seen good firms be really successful with when it comes to implementing value pricing? What are some of the outcomes that they've achieved from embracing these concepts?
Oh, the outcomes in the early days, and in the early days, it was the smaller firms that embraced value pricing and implemented it first, as you would expect, because innovation is bottom up. It's not usually top down. So the smaller firms glommed onto these ideas. Now that it's filtering up to the top 300, 200, top 100 firms, we're seeing profit growth 2 times, 3 times for some of these firms, which is amazing if you think about it, and happier customers. Just like with my landscaper, I'm happier to pay him 3 times more for giving me best curbside appeal than I would be if he was just doing a scope of outputs, right? So it's transformational, especially if the firm goes to the extent that we did and gets rid of timesheets. I think that's what transforms the firm eventually to a value pricing firm. You got to stop tracking time. It's just a superfluous measurement. There are superior systems like proper project management, where we track deadlines rather than inputs, after action reviews, where after an engagement is over, the team that worked on it sits around and does a 45-minute process like the armies around the world do. And that's how we capture our intellectual capital, our knowledge, our tacit knowledge. Investing just in those 2 things are project management and after action reviews far more valuable than all the time that we spend on doing timesheets, because timesheets don't give us the granular information on how to improve. They're kind of like the annual performance appraisal. We spend an enormous amount of time, money, and resources on annual performance appraisal, and they have zero impact on future team member performance. Zero. I mean, academics have studied this for decades, and I'm thinking, why are we doing this to ourselves? Whereas the after action review actually improves future performance. This is why fighter pilots use it. They go out on a mission or do an air show like your what is it, the Red Arrows. They'll come back and they're doing a 4-hour after action review. They're going through the whole flight. What went right? What went wrong? How could we do it better next time? Why aren't we doing this? Because we're spending time on timesheets, and it's a crazy measurement.
And I think your point there is valid, assuming that timesheet data is completely accurate and complete and reliable.
Yep.
I think that's a flawed assumption in a lot of cases to assume that data is
a great
actually...
understatement. My colleague Ed Kless did a survey across a bunch of different social media platforms. 76% of accountants admitted they fudged or didn't record the actual time spent on their timesheets. And the reason we don't, Mark, is because we don't want to look like an idiot to our boss. If I have to eat, I ate time all the time at Pete Mark because I didn't know what I was doing. There was no after action reviews to go back and read to see how to do this particular type of procedure in an audit. So I was kind of winging it, going off last year's work papers or whatever. But if I would have had after action reviews to look at, I would have been not only more efficient, but more effective. So yeah, I would borrow time, I would move time, I would fudge time, and supposedly eating time was a fireable offense. I still know of nobody in the accounting profession worldwide who's been fired for eating time.
Well, and it used to be this strange function of the profit and loss statement of an accounting firm that when I was in the profession, the flavor of one month would be we need to book all of our time as accurately as possible, capture everything that we possibly have because we need to understand the cost of doing this work. And then, sure as anything, a few months later, there would be the conversation, which is, well, we've got a bunch of engagements now where we're not making any theoretical profit on this. So we need to write off a load of the work in progress time that's on there. So why on earth is there all of this time on there? And it became if you whack one mole, the other one's head pops up. And nobody seemed to be able to understand that the profit and loss account statement of the accounting firm was somewhat flawed in the fact that it started with some kind of number, which was, if we charged the full amount for all of our time, it would be this much. And then our realization means that it's actually this much. It's just like, this is strange accounting to be able to achieve what?
Completely arbitrary too, because that number that you picked for your hourly rate has nothing to do with your cost, and it's got profit in it. And cost accountants don't allocate profit, they allocate cost. But there's even a worse thing about it, I think, Mark, which is, you know how we blame corporations for being too short term? Oh, they only care about their quarterly earnings, hitting their quarterly earnings. Well, think about what we're doing in the accounting profession. Talk about short term. We're trying to measure profit and loss by every hour. It's crazy. That's not how a system works. We've got a portfolio here that we should be maximizing the return on, not trying to break it down to hours or jobs or customers. We need to look at the portfolio the same way we do for our retirement portfolio.
I completely agree, Ron. And I think if we hadn't got people's attention already, the idea that you could double or triple the profit number in your accounting firm without having to go and win twice as many or 3 times as many clients here, we're talking about simply implementing better pricing strategies over predominantly the existing workbook or the existing workload of the existing team. That should be a very attention-grabbing statement. Implemented correctly, pricing strategies could double or triple your profit without significantly having to change the amount of work, the number of people, the number of clients that you have in your firm. One of the uniquenesses of the accounting profession is around the partnership model and how a lot of what we're talking about here ultimately sits to a partner's book of business and their client portfolio. So when we're thinking about pricing and maybe thinking about improving pricing, is this an area where each individual partner needs to become now a pricing expert and they need to acquire some new skills, new expertise? Or how do you think about that, Ron, given the sheer diversity that you're naturally going to have within a partnership group?
Yeah, this is a very contentious issue in pricing circles. Should pricing be centralized or should it be decentralized or somewhere in the middle? Like, for instance, FedEx, UPS, they have a pricing department, as do airlines, as do hotels. They have a centralized pricing department. They make all the decisions regarding pricing across the properties. The properties they cannot change those prices. And that's my preferred, because I don't think there's a lot of partners that just to say it, suck at pricing. They do. And everybody knows who they are, by the way. And not everybody should be good at pricing. I mean, authors and actors have agents, because if I'm selling you, Mark, or your business, I can be brave as a lion. I'm going to price you high. I'm going to tout your value. And, we can't do that when it's us selling ourselves, because we don't want to be braggadocious. So your pricers are kind of your spine. They make sure that we're not giving away work, that we're thinking about pricing strategically, not just tactically. How low do we have to go to win this client type of attitude? And when we see centralized pricing, we see better pricing. I promise you, Porsche is centralized pricing. So is Mercedes. Now, sure, the dealers have some wiggle room at the sticker level, but boy, those prices come down from corporate, and there's nothing they can do about it. And I like that, but that's a hard thing to do in a partnership model. That might be one bright light in the PE movement, because it is changing the governance model. So it's more of a corporate structure than a partnership. I mean, Margaret Thatcher's got the greatest line in the world that I think applies to partnerships, and that is, consensus is the absence of leadership. She's so right about that. I mean, you got to get 50 partners sit around the table and agree on the color of the carpet or the pricing. They're not going to do it. They're not going to agree, and somebody's got to make the final decision. But I'll tell you, I've never seen a big firm, like a top 100 firm, that centralized pricing. I've seen smaller firms do it. I suggest they set up a value council, or at the very least, partners should not price their own work. They should have to have another partner price their work. Because again, I can be brave as a lion pricing you, but I'm going to wimp out if it's my client.
Yeah, the fear of losing a client is far stronger than the desire to price appropriately, in my experience. And my experience in public accounting, even at the bid stage of putting together a document and the fee in there, the partner that I was working for was negotiating with themselves before they'd even put the price forward.
Exactly. I call it playing chess with yourself. Yeah, it's crazy. It's crazy.
It's something that always baffled me. It was like, we're so worried about losing this thing before we've even had a chance to win it. It's crazy to me that this is our pricing strategy. And sure enough, when the opportunity came, it was like, well, you can win this if you drop the price further. And magically that was made happen to be able to win the deal. And fast forward 12 months, Ron, it was, we're not making any profit on this one. We need to work out how we're going to make some profit. I was like, well, we shot ourselves in the foot before we even submitted the document.
And this is why I think pricers just think about this more strategically. The other thing is when we win a client, like in an RFP, and cut our price, we probably took a fairly good customer away from a CPA firm and turned it into a lousy customer for us. So we've destroyed value across the profession. And it just, I mean, pricing wars, one of the things that professional pricers are so proud about is if you go back and you look at the last 20 years, there have been very few pricing wars. Pricing wars used to be a heck of a lot more common than they are today. And it's because professional pricers hate pricing wars, because it just now they'll engage in surgical striking pricing wars where they'll, if you took a competitor took a client away from you in a particular area, they'll go into where you're strong and they'll take one of your good clients as a signal, hey, let's not play this game. And then that tends to stop the pricing wars. But I think that's a really great accomplishment, because pricing wars just destroy value.